Hello, and welcome to GARP's first CPD webcast. My name is Michael Sell. I'm GARP's ERP Program Manager. And this is, as I said, our first edition of what we hope will be a series of webcasts covering pertinent topics that certified ERPs and FRMs would be interested in learning about and earn credits for in their CPD activities. Given the sharp drop in oil prices over the past several months, we thought this would be a great topic to start out with and introduce to our energy risk professionals. And we're very happy today to have oil expert Morgan Downey with us today. Morgan is currently the CEO of Money.net. Prior to launching this new venture, he was global head of commodities at Bloomberg, where he tapped into his deep market experience to build a suite of innovative new products. Before joining Bloomberg, Morgan spent 15 years managing and running trading desks at various banks around the world, including Citi, Bank of America, Standard Chartered in the US, UK, Australia, and Singapore. Morgan frequently shares insights about global oil markets on CNBC and Fox Business TV, and is often cited in publications like the Wall Street Journal and the Houston Chronicle. In his spare time, Morgan authored the best-selling book Oil 101, which provides an in-depth overview of the oil industry. And with that, I will leave it to Morgan to present, but just a couple of quick housekeeping notes. As we go through the presentation, if any questions come to mind, you'll want to direct those to your chat box. There's a column on the right-hand side of your screen. Send us messages via that chat mechanism, and we'll be sure to try to get to those as we go through the presentation or before time runs out. So with that, Morgan, I will hand the baton to you.
Thanks very much, Michael, and thanks for having me here today.
Pleasure.
Oil is a very hot topic in terms of just, I guess, the speed of the movement in oil prices over the past 3 or 4 months has taken a lot of people by surprise. And what I'll go through here is I'll go through the context in which oil prices, why prices have moved down so rapidly, and then give a little bit of an outlook over what to expect over the next 6 months to a year.
Great.
So hopefully everyone can see this presentation. So here we have oil prices since the recovery at the beginning of 2009. And we were stuck in a 5-year, very tight range for oil prices between roughly $85 and $110 for almost 5 years. And it was up until August or mid-August of last year, so just a few months ago, that we were kind of stuck in this very tight range, and the range kept on getting tighter and tighter. And one of the key questions to ask is what happened here in mid-August 2014 that caused oil prices to halve in the space of 3 months. And what I'll show you here is that it wasn't one single event, but it was a confluence of a few critical events that caused this very rapid decline in prices. So there are 3 things. One, global oil demand fell or began to fall. Second thing, U.S. oil supply continued to grow relentlessly. And thirdly, Libyan oil supply recovered. So here you have a chart of crude oil prices versus global growth expectations, GDP growth expectations. And you can see that starting in mid-August, the market started to cut its assumption of global GDP growth for 2015. And oil prices kind of fell in line with that. You had almost every month, beginning in around August, the EIA, which is the U.S. government, the IEA, which is the OECD's energy organization, and OPEC itself started to cut pretty dramatically their demand forecasts for 2015. And these cuts really started to pick up pace in mid-August of last year. The second thing is, this is a chart of U.S. and global oil supply for the past, since 2009. And you can kind of see the the US and Canada is on the right axis, the kind of amber line, and the rest of the world is on the left axis. So global oil supply at the moment is around just 92 million barrels per day. But you can see that since the beginning of 2009, all of that growth in supply has come from the US and Canada. And in the US, it's come from frackers in North Dakota and West Texas, and in Canada it's come from oil sand producers, but most of it has come from the US frackers. And to kind of give a little bit more background, fracking for oil is a very, very new thing at scale. So it never really was used in a huge scale up until the beginning of 2009, but it's a relatively old technology. It's just that it's a very expensive and old technology. So fracking has been around since the 1950s, 1960s, but it required $75, $85 a barrel. We got that price in 2009, starting in 2009, and so fracking for the first time ever became economical beginning in 2009, and so that's when you had this huge takeoff in U.S. Fracking. So you can see if you're an OPEC producer or Saudi producer, you've had sideways production since 2009. So all of that increase in market share has been taken up by the U.S.
Morgan, if I could just ask you a quick question on the cost of fracking.
Yeah.
You said U.S. producers it's about $75 to $80 a barrel to produce at that level. How much more efficient, or how efficient do they need to, or can they become more efficient in order to compete?
So it is becoming rapidly more efficient because it's a relatively applying fracking technology to oil. It originally was mainly used for natural gas, but applying it to oil has only started before 2009. There was almost no fracking for oil. Now, and no fracking and horizontal drilling. So beginning in 2009, before 2009, I'll kind of back up a little bit, most oil production, new oil production, incremental marginal oil production, people would drill straight down. It was a vertical well. Beginning in 2009, people would drill straight down, turn the drill bit sideways, and then drill sideways for 2 or 3 miles, and drill through the oil reservoir. And then they would pump down water, which is the first part is horizontal drilling. Then you pump down water at huge pressures, and there's a separate drilling crew or fracking crew that arrive on site to do this. The big fracking crews are Halliburton, Baker Hughes, Schlumberger. They would arrive on site. You've got to pay them. So you've drilled a well, you've drilled it sideways, and now you're paying additional money to frack it. And so you add up all those costs. And on the high end, it's $75 to $85 a barrel. On the low end, it depends on what type of rock in it. It can be as low as $40 to $45 a barrel. So it's not a discrete $75 a barrel point. There's kind of a cost curve, and that cost curve has become more efficient over the past few years. Then you had Libya back in July, August. This is how much oil has been taken out of the market. The yellow section here is Libya. A little bit more stability in Libya, so there's less disruption. So Libya added roughly almost 750,000 barrels, or 1 million barrels almost, of additional supply beginning in August. So the net result of all of this is that starting in August, someone, either OPEC, which is around give or take 40% of the global oil supply, or non-OPEC, which is people like the US, Russia, someone needs to remove 1 to 1.5 million barrels per day from the market. Otherwise, that oil is just going to go into storage tanks and push the price lower. And so this is where you can see, here is the forecast for 2015. We're overproducing by, give or take, it's around 1 million to 1.5 million barrels per day. Traditionally, OPEC has cut back production. Before OPEC, you had the Texas Railroad Commission, and before that you had Standard Oil, but there's always been the ability of the oil market to overproduce by a little bit, but that little bit is critical. So for OPEC have roughly 2 to 3 million barrels of spare capacity right now. If OPEC had been adhering to their traditional mandate, which they've exercised since 1973, they would cut production. They met in November of last year. They should have cut production by 1 to 2 million barrels per day. They did not. And that is what kind of was the last straw to break. So you had cutting demand forecasts for global growth, oil growth. You had U.S. supply relentlessly growing, mainly from frackers, these high-cost oil producers. And third thing, you had that Libya recovery in production. And then the final straw was that you had OPEC facing this too much oil being produced, refused to exercise their mandate, which their self-assumed mandate to cut back supply to support prices. So beginning in August of last year, OPEC said nothing, which was very, very unusual. There's always, anytime oil prices dropped below, for over the prior 5 years, dropped below $90 or came close to $85, OPEC would start talking up the market, threatening that they were going to cut. When prices just began to drop back in August of last year, OPEC said nothing, which was very, very unusual. OPEC had a meeting in November where they discussed cutting back by 1 to 1.5 million barrels per day, which would have kept prices up at $80, $90 a barrel. At this OPEC meeting, the CEO of Rosneft is a large Russian oil company, but this guy, Igor Sechin, went to the OPEC meeting. Russia is obviously non-OPEC. But he went to the OPEC meeting. Saudi Arabia, which is the big brother of OPEC, they're the guys that really carry most of the cut most of production when it needs to be cut. Saudi Arabia trying to get agreement from Russia to cooperate on an OPEC and Russia cut. This guy that apparently was representing Russia at this meeting said no. And not only did he say no, he said no publicly. He actually said Russia will not cut and doesn't have the ability to cut. He gave some excuse about winter approaching or something like that. But basically, he had a last-minute deal fell apart, and the Saudis said, well, if Russia's not going to cooperate, we're not going to cut. And then finally, you have this situation where Saudi Arabia is looking at their long-term revenue, and the Saudis are seeing more and more of their market share being taken by these US frackers. And so the Saudis, rightly or wrongly, believe that if they can push prices below by not taking oil off the market, but allow prices to drift below $75 for 6 months, a year, maybe even 2 years, they can bankrupt this new source of supply from the US, because there was a whole bunch of theories about what the cost of production is for these frackers. But the Saudis believe that the cost from these frackers is very high, and they can wipe out this competing source of oil supply. Why the Saudis? A lot of people ask, what's their financial status? They've got record low levels of government debt. Their debt to GDP is at record lows, because bear in mind, we've come from a period of $100 plus oil for the past few years. So their debt levels are very low. They've got almost $300 billion in cash reserves. So their cash reserves are very high. And they came out with their budget for 2015, assumes at $65 oil, basically linked to WTI, the Saudis are going to have to borrow at roughly $40 billion for or either borrow it or dip into their cash reserves for 2015. Bear in mind they've got $300 billion or close to $300 billion, so they've got the financial wherewithal to bankrupt the US source of supply from all these frackers. And then over the long term, the Saudis are hoping that you remove supply from the market, the Saudis can produce extra in the coming years, and the net revenue impact is positive for Saudi Arabia. So
just one question with respect to that last point, Joe, about the U.S. position. What impact has falling fuel prices, let's say diesel fuel, fracking requires diesel, what impact has falling fuel prices impacted the marginal cost of production for U.S. producers, and has that been a big enough impact to sort of offset this?
No, it's not. It's not as big an impact. So falling oil prices they've helped a little bit with the efficiency of fracking itself.
So they're not seeing enough of a bang reduction in their input costs to offset the falling revenues. Also, one other question: How can how's this going to all play out? Is this correct to say that Saudis can bankrupt U.S. producers? Theoretically, I mean, what arms do U.S. producers have to sort of offset or fight against this? They've got huge dividends they're paying out.
Yeah, the two things that have, which I'll go through in a second, that have started to happen is one is efficiency. So you're already seeing the actual guys that do the hydraulic fracking, Baker Hughes and Halliburton. There was a merger a few months ago. So you're seeing, and that's to make the fracking and horizontal drilling process much more efficient. So you're seeing the one thing they could do is efficiency. The other thing is that fracking it's kind of like a just-in-time process in that you frack, you produce for 6 months or a year. Before fracking, you would produce for 5 years or maybe 10 years from a well, on average. I'm just generalizing here. But fracking is a very short-term process. And so the largest U.S. producer is Continental Resources from fracking, Continental Resources, and they have cut their CapEx for 2015 hugely. So basically the U.S. oil industry is looking at $45 oil today and have said, we're going to park everything for the next 6 months or a year. So there's efficiency, but there's also, these guys are retrenching, cutting back on spending. So I'll just give you, so that was kind of the context of why prices fell with the confluence of those four issues. And I'm just going to go very quickly through a bit about global oil demand. You can see that oil demand is still growing. It's not that oil demand is going negative. Oil demand almost never goes negative. That 2008-2009 period was highly unusual for a negative growth in oil demand. Most oil demand is coming from Asia and developing economies. So OECD, the OECD world, you can see is kind of almost flat for 2015. But there's sort of strong demand from Europe, from Asia and developing countries, but it's just that demand isn't as strong as it had been forecast earlier. So demand is still growing, demand is still strong, it's just not as strong as it had been forecast to be earlier. On the supply side, this is global oil growth for 2013, 14, 15, so the past 2 years and next year. And you can see who's dominating this. And even in 2015, with lower prices, the US is still going to increase oil production. So that there's this is kind of the chart that kind of frightens the OPEC, because they can see that the US is eating more and more market share. And you can see that here you've got a chart of US oil production is one of the major is the major new source of oil supply. But now going back to what happened in August, these are the amount of drilling in the fracking regions of the US. The Permian, Eagle Ford, which is in West Texas, and Bakken is up in North Dakota. And you can see that the number of wells being drilled has fallen off quite dramatically in the past few months. So this will result in US supply not growing as much as it had. So there's a supply side reaction to these lower prices already being evidenced in the market. In terms of just hyper-local impacts, this is a chart of unemployment growth since the recession in 2008. And you can see that Texas has grown hugely, its employment base, mainly because of oil and gas, but primarily oil. North Dakota is kind of a similar situation. But so certain states, Texas and North Dakota in particular, are going to be highly impacted by these lower prices. But for the rest of the economy, the rest of the US is still a net oil consumer. The US is a big producer, but net, it's a consumer. So net lower oil prices are good for the US economy, but for Texas and North Dakota, it's kind of almost approaching a disaster for those two states. So what happens next? So here we have the price since 2005. We had a big spike in 2008, which was due to there was conventional oil supply wasn't growing very rapidly, but you had a large increase in demand every year. And the price had to go to a high enough level to kill demand. And so it had to go to an extreme level, almost $150. Then you had the credit recession in 2008. Since then you had sideways for 5 years and a big sell-off in the past 4 months, halving of oil price in the past 4 months. For the next 2015, we're going to be stuck in this new range, and it's a very low range. You're going to have $50 on the low side, $70 on the high side. Below $50, as I showed you, the drilling falling off, you're going to get supply side reductions. So that will put a floor to oil prices. Above $70, all these frackers are going to restart again. And so we're going to be stuck in this range for 6 months to a year, unless a few things happen, which I'll go through in a minute. Inventories are going to hit all-time highs. This is the OECD. So you can see the forecast for the next coming year. Crude oil inventories are going to hit seasonal highs. This is the OECD. This is now the US. US, we're kind of off the charts in terms of crude oil inventories are very high. At the bottom, you can see gasoline inventories are very high. But here's one of the most unusual things that not that many people talk about, and you mentioned, Michael, diesel. And if you guys have probably seen at the pump, gasoline is in many places now below $2 a gallon, but diesel at the pump is still stuck up at $3, or give or take, up very high. And you can see that here, diesel inventories have been falling since middle of 2010, quite rapidly in the US. And so there's a few reasons for that. One is that the US economy hasn't grown hugely in the past few years, but it's grown a decent amount. The major reason for diesel prices not falling in the US versus gasoline prices is that there's a ban on exporting crude oil in the US. And so there's all this new oil being produced in North Dakota and West Texas, but it can't be exported into international markets. And so what people are doing instead is that a lot of companies are exporting refined products, so they're refining the crude and exporting. And so exports, this is mostly the bottom line here, have grown rapidly since 2009. So, and that's one of the major reasons why diesel prices in the US haven't fallen, because a lot of that diesel is being exported to South America and Europe. A few years ago, back in 2009, 2010, people said that gasoline demand will never go back to its highs and never grow again in the US. Gasoline demand has actually grown a decent amount in the past several months. And this chart involves some weekly data, which is smoothed out by more reliable monthly data, but which will come in the next month or so. But you can kind of see that there's US gasoline demand is actually reacting to lower prices. So we're heading towards what looks like will be a very strong year in 2015 for gasoline demand. So it's at least in the US. Okay, so what's next for oil? What I call the known unknowns. Things that may cause much higher prices in 2015. You could have a terrorism event affecting infrastructure in a large oil-producing nation. The oil industry always has a large number of disruptions that occur. The likes of Nigeria and Iran and a whole bunch of other countries have political challenges. But you could have a major event in Saudi Arabia or somewhere like that. The second thing is that US frackers, they've started to cut production. If they cut much more drastically than they've started to, then that could cause oil prices to rapidly recover. One of the kind of left field things that could happen, Russia and OPEC could agree to cut supply. At the OPEC meeting back in November, they couldn't agree to cut supply, but there could be some sort of agreement between OPEC and Russia that could cut supply. As mentioned, someone needs to remove 1 to 1.5 million barrels per day. OPEC is betting that removal will come from US frackers shutting in production or even going bankrupt. If that doesn't occur, then maybe OPEC and Russia will cut supply.
What do you think the odds of that happening are? I mean, a lot of these OPEC countries are pretty dependent on high oil prices. Yeah. And there's also the idea out there, I've heard floated, that perhaps this is all some sort of arrangement to put the squeeze on Russia. Yeah. I mean, what is the practical reality of that happening?
So I always have this theory that the likes of Saudi Arabia and other large oil producers, they tend to separate their political machinations from their oil industry. And so they act relatively economically rational in terms of oil economics. Right. And the fact that it has lower oil prices have negative impact on Iran and Russia and Syria, that's kind of a side benefit, but I don't think that's the primary reason that Saudi Arabia is looking at lower oil prices here. It's kind of happens to be coincidental. Right. And so yeah, lower oil prices should result in a more stable world in terms of a lot people will be more willing to cooperate in terms of Iran and its nuclear program, and Russia and its Ukrainian situation, Syria. So lower oil prices kind of take some fuel out of all those hot political issues. But it's a side benefit in that OPEC and the Saudis are acting relatively economically rational in terms of what they're trying to do.
Well, a lot of these countries, they're fighting weak currencies as a result of all this.
Sure,
and some of them are probably sort of hitting the limits on their reserves, currency reserves, to fight that. Yeah. I mean, will that have any impact here? Or
yeah, I think
if and when will it?
So here's why I think that Russia and OPEC may do something. At the November OPEC meeting, the Saudis apparently offered to cut production. Russia, if Russia would agree. Russia said, we're not going to help. And they said it in a very strange manner. They said, we cannot help. but the Russian economic situation is now dire. You've got the ruble is is heading even more, getting worse. Inflation is now a huge issue. And so there's going to be a lot of pressure on Russia to come back to the table, to OPEC, and say, okay, last November we didn't agree to any cut, let's agree to something right now, just to get prices back up to $75 or $80 a barrel. So I think that of all the events that could happen this year in 2015 that could cause oil prices to recover back up to $75, Russia is key to that. And it would be Russia plus OPEC would be a key component in that. And so yeah, that's kind of one of the things that could happen. Here's just there's always some disruption in oil supply. Here's non-OPEC disruption. You've got issues in sometimes it's the North Sea, or you'll have Sudan or South Sudan. You'll always have a certain level of geopolitical tension happening in the oil market, but the oil market is kind of assumes a certain level also. So it's not something the oil market is not. That would be unexpected for the oil market. So the gist is we're going to go sideways between 45 and 65 for 2015 unless Russia comes back to the table to OPEC and agrees to a cut in production, and they need to cut 1 to 1.5 million barrels per day.
Right.
Okay, so that's it. I realize I kind of powered through the presentation.
Yeah, that's fine. It's you're very passionate about it and very enthusiastic about it. A couple of questions have come through. Actually, one of them is about inventory, and I actually wanted to ask you about this. We saw a lot of offshore storage back in 2008, 2009, the last big dip we had in crude prices. What are you seeing in terms of inventory and where things are being stored, and what does the storage market look like these days?
So there's a lot of oil being stored on tankers at sea, and it's almost more of a function of the oil tanker market. So back in 2007, 2008, the world started to produce a lot more oil tankers, more than was needed. These huge super tankers, they take several years to go from initial planning to production. And so what we're seeing now is a legacy of the overproduction of oil tankers, which began in 2008. So there's this cheap inventory or cheap ability to store oil at sea, and so you're starting to see a lot of oil being stored at sea at the moment. So
what is that pricing like? What is the economics of storage?
So it depends on a whole bunch of different things, but a rough rule of thumb that people use is 50 cents a barrel per month for storage. Okay. So if you want to store a barrel of oil for a year, you're talking about $6 a barrel to store it for a year. So if you buy it for 50, your storage costs are going to be bring it up to $56 oil. Sure.
And some other questions that have come through. Have you as frackers done anything to hedge this scenario other than cut capex spending? Is there anything else?
So a lot of these guys had hedges on, and when I say had, the biggest, most infamous hedger was Continental Resources. So they had hedged a very large portion of their 2015 oil production and a little bit of other years. But when oil fell back in August, at the beginning of September, fell down to $80 or close to $80, Continental Resources said, "Oh, this is ridiculous. We're going to take our hedges off." And they unwound all their hedges, or a lot of their hedges for 2015, thinking that they could just monetize that small drop in prices. But obviously, prices continued to drop down to $45. Right. So it was one of the worst. Hedging is one of those things that you should do it. It should be programmatic. You should just continue to do it and ignore the market. Hedge, just have a constant hedge ratio. And you shouldn't, because if you go put hedges on, take hedges off, you're now no longer hedging, you're trading. And so Continental Resources is an oil fracker. They're a huge oil fracker, but they're also now an oil trader, financial oil trader. And so they've taken off a huge portion of their hedges. Other frackers have left some hedges on. So it kind of does soften the blow a little bit.
Right. You had mentioned the exporting of oil, or the inability of the U.S. to export oil?
Crude oil. Yes,
oil.
Yeah. So you can export refined products,
right,
like gasoline or diesel, and so it's one of these things that anytime the government of any country, not just the U.S. but any country, puts these artificial limits on commodity trading or the flow of physical commodities, and it results in all these unintended consequences. And so if you ban crude oil exports, people are going to get around it by minimally refining crude oil to turn it into some sort of refined product and then exporting that refined product. And so you're starting to see a lot of diesel and heating oil being exported kind of as a proxy for crude oil. So people can't export the crude, I'll just minimally refine it and export the diesel instead.
Do you see any situation where U.S. policy might be lightened a little, that you might get some of the crude out of the country?
Yeah, I think there's the longer term trend that ban on crude oil exports will be lifted. And because net, it doesn't affect the price of the oil is set in the global market. And so if the US has a ban or doesn't have a ban, all it does is it creates this regional weirdness in US oil pricing where you've got diesel at $3, gasoline at $2. You've got, it's basically, that is a, that's kind of, but if you go to Europe, you don't have that extreme situation, or other parts of the world. So the ban on US crude oil exports, it doesn't change the price of crude oil. All it does is it results in these, that the industry having to jump through some silly hoops to export oil in the form of a refined product. So it's a silly rule. It should never have been put in place in the first place. But governments around the world, they try and react to oil prices by putting all these rules out.
Well, like a lot of these rules were put in place for a different scenario that happened a long time ago, and they never.
Crude oil export ban is a remnant from the 1970s.
Exactly. So the spread between TI and Brent has come in quite a bit. I mean, it's like $1 or so now. Can you talk a little bit about that and what the implications for that on the general market?
Yeah, and so over the past few years, a lot of people have said Brent has become the global benchmark, and it kind of always, because it's a seaborne crude up in the North Sea, it is a much more able to react to global supply and demand changes. WTI is deliverable in Cushing, Oklahoma, which is a landlocked, it's linked with pipelines to the rest of the U.S. But WTI was kind of distorted by all this new fracking supply and all this Canadian oil sands supply over the past few years. Because there's been a whole bunch of pipelines built, as well as pipeline directions have been changed, so pipelines used to go from the U.S. Gulf Coast up into the U.S. Now a whole bunch of them have been changed to go from the Midwest down to get all this new oil supply out. But that whole situation took a few years and is still ongoing. That whole rejiggering of the U.S. pipeline situation has taken a few years to turn around. But you're basically starting to see that the oil market and the transportation of oil is reacting to the wide difference which occurred with Brent and TI a few years ago. And you play this out 3 or 4 years, WTI should potentially get back to parity and maybe even go above Brent again. But this is going to take 2 or 3 years. So the disparity between Brent and WTI is a function of WTI is in Cushing, Oklahoma, was unable to react to all this new supply that came from North Dakota and Canada. And so longer term, you're going to have a resumption of WTI at parity to Brent, but that could be 2, 3, 4, 5 years from now.
Right. Interesting. A couple of questions from some ERPs that have come in. One is who in your opinion is the most vulnerable to this continued drop in oil prices? Is it the U.S.? Is it OPEC? Or is it Russia?
I think it's Russia. Yeah. Russia they are the guys that have got they have the most to lose, and they are losing the most right now. It's happening to them in real time. Right. And so these guys, their currencies in the toilet, the inflation rates gone through the roof. They're hugely dependent on oil. One of the other economies, though, that in the U.S. you've got regional economies that will be hurt, Texas and North Dakota, but on average across the U.S. it should actually be net slightly positive lower oil prices for the U.S. one of the countries that people don't really talk about that much, but is also a petro state or petro economy, is Canada.
Yes.
And because Canada has become a much larger oil producer in the past few years, even there's the Canadian oil producers, all these oil sand producers, but then there are all the banks that lend to these Canadian oil producers. So the whole economy in Canada is highly oil levered. And so it's one of those countries that people don't really mention as much when it comes to lower oil prices hurting or helping. It massively hurts the Canadian economy.
Yeah, where's the current spread or price of Canadian crude relative to TI? I know it was priced at a pretty big discount for some odd reason.
Yeah, honestly, yeah.
The last several years.
Yeah, so basically, you had it's Canadian very heavy oil. Because you basically the Canadian oil sands. It's one of those. It's like fracking and Canadian oil sands only became economical with really high oil prices. Because with Canadian oil sands, you're scooping dirt off the ground, melting the oil out of the dirt, and you melt it using a fuel like natural gas or something like that. And it's like a mining process and a manufacturing process. And at the end of that whole process, you get still very heavy oil, which you've got to refine a couple of times. So it's a very expensive source of oil, which means that it has to be priced at a big discount to make it economical versus other less difficult crude oils.
Right.
And so it has been at a very low price.
So where is it now? Is it?
It depends on, but some mid-30s. Mid-30s.
So it's still at a discount, but not quite as given the current dividend price in WTI, for example. Yeah. Okay. A couple of other questions from the audience. So in 2008, we saw a lot of positioning in global commodities, notably oil, as a result of a weak U.S. dollar and inflationary hedging. Do you think we are seeing elements of this being reversed as the dollar gets stronger and Fed moves to raise rates?
Yeah, that's another reason why oil prices have sold off. Oil is a currency. You can buy and sell. It's a real. You can barter with it if you want to buy food or goods. But as the dollar goes up, oil prices go down. It's just the U.S. dollar is strengthening versus everything, including oil, which is it's a commodity, but it's also a currency.
Right.
And so if this dollar keeps going stronger, which obviously that trend has been in place now for a few years, that's another factor which has kind of pushed down oil prices.
Right. It's just kind of an exponential movement down at that point. Let's see, we kind of covered that. Long term, is OPEC going to target a price just below the U.S. fracking marginal cost to keep them out of the market, or at least keep U.S. production growth low? We may have touched on that, but maybe you can expand on that a little bit.
So OPEC is really just Saudi Arabia. All the other guys, there's a whole bunch of members there, but every member apart from Saudi Arabia pretty much produces as much as they can. They all produce at full tilt. So basically, when you talk about OPEC, it's always just good just to talk with Saudi Arabia because they're the only ones that count and that act on behalf of OPEC. Mm-hmm. So the Saudis, in their government budget, which is hugely dependent on oil, it's like 95% dependent on oil. They budgeted for $65 for this year, for 2015. Their break-even price, where they don't have to borrow, is $80 a barrel. And so one of the net outcomes of this could be OPEC is basically trying to find out, or the Saudis are trying to find out, what is the marginal cost at which these U.S. frackers cut back supply. Because if, as has been alleged by some individuals, the U.S. supply is very efficient. Some people say that frackers only need $40 a barrel. There was a report from Goldman Sachs yesterday saying that they're expecting oil to touch 40 because that's the true price where you get a huge reduction in U.S. supply. If that's the situation, OPEC has played this game all wrong. If U.S. frackers can still produce at $40, this has been one of the worst decisions ever by OPEC. But if supposing, which I don't believe it's that low, I think it's maybe $60, $70 a barrel. If OPEC, if U.S. supply starts to produce at $60, $70 a barrel, I think that's kind of a price level where OPEC would be okay with living at that kind of price for a few years. Bear in mind, Saudis have budgeted for $65 for this year. Right. And they've got, if oil stays at $65, the Saudis have got almost 10 years of cash reserves to live at $65 oil.
Right. So what country is benefiting? I mean, aside from, how is Asia benefiting from all this? How is China benefiting from all this?
It's a huge benefit for Asia. Asia has been the largest source of growth over the past few years. They're a net consumer of oil. The main winners in this whole situation have been China, India, all of the Southeast Asian nations, which are huge oil consumers. It's been a huge tax break for all those countries. So
what are they doing? Are they just stocking up? Are they buying at these low prices? Are they waiting for it to go lower?
China's filling its reserves, its government reserves. So most developed countries, OECD countries, have got strategic reserves. So the US has got what's called the SPR, Strategic Petroleum Reserve, down in the Gulf Coast. China is building up its strategic reserve because it's a net consumer, and so they're trying to build a buffer in case there's any supply disruption from the Middle East or other locations. So the Chinese government is filling their strategic reserve actively, but they've been doing so for the past few years. This just makes it much more inexpensive for them to do that.
And what about countries like smaller producers like Nigeria and Ghana? How bad are things?
It's pretty bad for those economies. I mean, they're hugely oil dependent economies. And then another country that is, there's the BRICS, which is Brazil, Russia, India, China. So for Russia, this is a disaster. For China, it's great. For Brazil, this is a disaster. Right. And so Brazil is meant to be, a few years ago, back in 2008, 2009, Brazil discovered this huge field, the 2B field, or it's been renamed.
Large offshore, deep water.
Ultra deep offshore. And so as oil prices got higher, all these more unusual sources of oil became economical. So Canadian oil sands became economical at $40, started to become economical. Fracking started to become economical at, depending on the US, $45, $50 for the very efficient guys. But then you go ultra deep offshore to Brazil. Brazil only becomes economical at much higher prices again. So they've been spending billions of dollars on exploration and starting to try and build production facilities for these ultra deep offshore reservoirs. But if oil prices stay at $45, $55, the Brazilian economy is in dire situation because they're spending all this money expecting oil to be at $100 a barrel.
Right.
If it stays at 50, that production is going to be hugely uneconomical, and all that spending will have been wasted.
Right. So we're running up. I guess we're running close to the end here, but I have one other question to ask you. The last time we had a big oil, let's call it price shock like this in the U.S. was really sort of in the mid-'80s. Right? We had a lot of.
There was the 2008.
2008, excluding that.
Yeah.
I was thinking specifically the mid-'80s shock and the ramifications that had on real estate prices in this country and the economy and local economies like Texas and in Colorado and whatnot. How do you compare this situation with that situation? And can it get as bad as that, or is this just more of a blip, short-term blip?
It is very, very similar. It's the dynamics are very similar to the early to mid 1980s. And the only thing that can save, it sounds ironic, but the only thing that can save Texas now is Russia cooperating with OPEC to cut back supply. But any of these large oil-producing states in the U.S. that started fracking the past few years, if oil prices stay here, if OPEC do nothing, either by themselves or do nothing in cooperation with Russia, we're going to have a very bad situation in Texas and North Dakota because all of these guys, even if they're very efficient, the economies there are hugely dependent, or have been. A lot of the growth has been hugely linked to oil prices being at $100 a barrel. If oil prices stay at 50 for 6 months to a year, or 2 years, or 3 years, you're going to have the exact same, very similar situation to the mid-1980s, where there was a major localized recession in the U.S. It was localized to the Gulf Coast and other oil-producing areas.
Right.
So Russia needs, Texas should be hopefully betting on Russia to cooperate with OPEC.
Yeah. Well, they seem to be feeling a lot of pain now, so I find it, it'll be interesting to see how it plays out.
Sure,
Well, I think that exhausts our list of questions from the audience. We're pretty much out of time, so we'd like to thank you all for joining us. And again, we'll be looking to schedule some more of these chats in the coming weeks and months. And we appreciate you taking the time to join us today. Thank you very much.